In this video, we'll go through the different types of analysis you can use in trading to predict where the price will go next. And as mentioned earlier, I mainly trade Forex, so the course will mostly focus on that, but most, if not all you learn in this course can also be applied in crypto and stock trading. In order to make money in trading, we need to bet if the price of an asset or currency pair will go up or down. But how can we actually predict this? We use market analysis. Market analysis consists of the following: fundamental analysis, sentiment analysis, and technical analysis. The analysis can be done using a combination of the three or just one of them. So let's walk through what these methods of analysis is and how it can be applied to trading. Fundamental analysis boils down to how an asset or a currency pair reacts to economic, social, or political news. To understand this, we can use a stock, for example Apple. Apple can release an economic report saying that they made much more sales than expected, which can drive the price of the stock up. On the other hand, if the European Union suddenly decides to ban all Apple products because of a shocking reveal about the company, the stock can drop massively. In Forex, economic news, for example the unemployment rate in the US, can heavily affect the price of the US dollar. In Forex we have economical calendars showing us all the expected news and how much of an impact it's expected to have on the market. I'll leave a link in the description if you want to check that out. For stocks, you'll just have to follow the news and rumors regarding the specific company you trade. If you haven't already seen it, more often than not, when big companies are having grand reveals of their next big products for consumers, price tend to not move as much as one could expect. This ties back to the old saying, buy the rumor, sell the news. This means that the reveal has already been factored into the price either days, weeks, or months before the event, all because of the rumors and anticipations of the new products. What on the other hand can really affect the price is when the news that is released doesn't match the expectations and the rumors. For example, if in the news event with the grand reveal of new products, the company also say that they have a major manufacturing problem and because of this the release date of the new products has been pushed for another 2 years, this could have a massive impact on the price of the stock. But how can you trade it? Some traders enter positions way ahead of these news when there is just a rumor of something's going to happen. Or in Forex because other political and economical signals might suggest that this or that will happen. Other traders wait until after the news has been released and catch the ride when the stock or currency pair goes up or down. And others, myself included, don't trade in news at all. I even close my positions before high impact news because of the increased volatility and the uncertainty it brings. The sentiment analysis is used to gauge how other people feel and what they believe about what direction the market should move in. When I say other people, I mean all the other traders in the market as a collective. You can look at the price chart and see that the price has been going straight down for 10 days. This means that most people for the past 10 days believe that the price should go down. Or if the price hasn't really moved anything for the last month, it suggests that most people believe that the price is where it should be. How you incorporate this into your trading is entirely up to you. You can either follow the sentiment or go against it if you believe the massive downtrend is about to turn. The last, but in my opinion the biggest of them all, is technical analysis. With technical analysis we use price charts to study what price has done recently and historically to find out what price might do next. The way this works is that we use patterns and indicators to find setups that tend to repeat itself over and over. For example, when using what's called support and resistance, if price rejects of the resistance level, it usually goes down to support again. Or if price pulls back to the 0.5 Fibonacci level and then starts to go back up, it's usually a sign that price will continue upwards. Technical analysis is a very powerful tool, but it cannot predict the future. It can only tell us that based on the historical data, that this is usually what happens. We also need to keep in mind that how we apply the different techniques and how we interpret the data is very subjective. What you perceive as a support level might not be remotely close to what Jerry sees as a support level. I will not dive any deeper into technical analysis in this video, but most of the course will focus on the different ways of doing technical analysis as it's the most powerful tool we have to find out what price might do next. To sum things up, when we do our market analysis to find out where the market might go next, we use three different types of analysis, either in combination or by itself. Fundamental analysis is how the news and other events affect the price of a currency pair or an asset. Sentiment analysis is what direction most of the other traders feel and believe that the market should go. And finally, technical analysis is how we take historical price data to find patterns in the price that usually repeat themselves. This way we can tell what the price usually does when this pattern appears. In the next videos, we will focus on technical analysis using price charts in TradingView. But the very next video will be a short tutorial on how TradingView works and the basic things you need to know before starting with your technical analysis. Make sure to like the video and press that subscribe button so you don't miss it when the next video is released.